Thank you for coming out. It is freezing outside. We're sandwiched between two snowstorms. I hope everybody got their shovels. I know I stopped at the hardware store and got myself some more salt this morning. So it's time to stock up. I wanted to start out tonight something a little bit different. I got a boring dad joke, but I saw this the other day and I figured it's good for tonight. So question: Why did the man put the money inside his freezer? Yes! That's awesome. I said that to my kids, and they both groaned and walked away. So tonight, I wanted to start out much like we did last time. I'm going to move my chair a little bit because I feel like... All right. Can't see you guys over here on this end. All right. I wanted to start out with a survey, get the temperature of the room, see how you guys are feeling. And that'll help us to drive, what we talk about tonight and talk about things that you guys actually want to hear about. So what I'll do is I'll ask the question, go over the options, and then I'll kind of repeat it. Everybody just put your hands up, whichever one you feel like. You can answer multiple answers if you want, whatever you're feeling. There's no rules. Question one, which best describes how you feel about the markets heading into 2026? Very optimistic, cautiously optimistic, neutral or unsure, concerned, or very concerned. Okay, so let's see hands for very optimistic. All right, awesome. Cautiously optimistic. That's like every analyst on Wall Street every single year. Neutral or unsure. All right, thank you. Concerned. Okay, very concerned. A few hands up on that too. All right, very good. So I think most are either cautiously optimistic or slightly concerned, right? Yeah, okay. All right, that's pretty good. All right, question number two. What concerns you most as we head into 2026? Market valuations are way too high. Accelerating inflation. Interest rates staying higher for longer. Economic slowdown or recession, geopolitical or political uncertainty, or I'm not particularly concerned right now. All right, so who's up for number one? Market valuations are way too high. All right, couple hands. Inflation reaccelerating. Okay. Interest rates staying higher for longer. All right. Economic slowdown or a recession. All right. Geopolitics or political uncertainty. All right. Nothing going on there, right? I'm not particularly concerned right now. All right, thanks, John. All right, so I would say geopolitics is the number one driver there. Okay, great. Number three, how much volatility do you expect in 2026? Less than in recent years? About the same? More than recent years, or not sure? All right, so less than in recent years. Nobody, okay, very good. About the same. Okay. More than in recent years. Okay. Not sure. All right, okay. So either about the same or not sure, all right. And then number four, this is the final one. How do you currently feel about AI and technology-related investments? Very excited, interested but cautious, neutral, concerned about hype, not something I focus on. So very excited. All right, a few people. Very nice. Interested but cautious. Okay, all right. Neutral. Okay. Concerned about hype. Right? And then not something I focus on. Okay, so I would say interested, neutral, that's kind of like the reigning champs there. All right, awesome. Well, that'll help guide us our conversation. Thank you very much for participating. All right, so I just want to do a quick recap, or not a recap. I just want to introduce kind of like our 2026 outlook as the Paragon team, okay? This is something we worked on for a long time. We really took our time and talked to a bunch of analysts and a bunch of industry experts and things like that. And we came up with the theme of cautiously optimistic. No, I'm kidding. we came up with the theme of optimistic but not naive, which is essentially really the same thing, just said in a different way. But we are optimistic, right? And there are reasons why we're optimistic, right? Heading into 2026, we have very positive economic growth going on, right? The Fed expects, this is the Federal Reserve, expects 2.3% GDP this year. That's their estimate, okay? And we're hearing, some people say upwards of 3%, 4%, even 5%, depending on who you talk to. But the Federal Reserve, which, they're the ones that are setting policy, they're thinking 2.3%. Just to give you an idea, developed countries, the size of ours, generally it's pretty good if you can even stay around 2%. So 2.3 is actually above average. So that's not a bad thing that the Federal Reserve is expecting, that we're a little bit above average in our economic growth. And actually for the current quarter, for Q4, right now the Atlanta Federal Reserve is expecting 5.4%. That's their estimate, year over year. Corporate earnings are continuing to expand, all right? So for 2025, analysts are expecting 15% year over year in earnings growth for public companies, for the S&P 500, okay? So that's an estimate. We don't know if that's actually going to happen or not, but that's their expectation going in. And it's actually, those earnings are actually starting to get a little bit stronger. Usually there's a little bit of a dip going into the quarter, but they're actually getting stronger for the year. So analysts at large are actually pretty bullish about the companies within the S&P 500, generally speaking. And then monetary policy is no longer acting as a major headwind, right? So 2022, interest rates started getting higher. 2023, they were still higher. 2024, 2025, they started coming down. And the expectation is this year, they'll come down a little bit more. Federal Reserve themselves are expecting that they're probably going to reduce rates, twice this year. That'll bring the reserve rate to about 3%, more or less. So, if you have your money inside a money market, maybe not so great. But if you're looking for a mortgage, okay, that's good, right? That's going to spur some activity. We have some business owners here. If you need to get a loan, maybe your loans are going to be a little bit cheaper. So that should also spur some business activity as well. So all those conditions are really good for long-term investors, right? Because what we want to do is want to make sure that there's a sustainable growth to the economy, and all these things are pretty good for sustainable growth, okay? At the same time, we do have some elevated valuations, right? You have the S&P, their forward earnings are at 22 times. That may not mean anything to you, but that's higher than normal, okay? You could say that the S&P is a little bit different now than it was 20 years ago, but nonetheless, people look at that, okay? You have policy uncertainty. Aside from everything that's going on in the news, we also have midterm elections this year. Generally speaking, the market doesn't like midterm election years. It's not necessarily the best year in the market. So we have that going for us as well. And then we have the big one that everybody seems to be worried about is geopolitics and geopolitical risks. I don't know about you guys, but I did not have, a Venezuela president being captured, Greenland being part of the U.S., none of that was on my bingo card for this year, and that's already happened, and we're not even done the month of January yet. So who knows what's going to happen between now and the end of the year, okay? So that's another big one. And not that the market doesn't typically, and Eric, you're a much better student of history than I am, but typically the market doesn't necessarily care about geopolitics, but it doesn't mean that the headlines don't cause volatility, right? And that's really what we're looking at. So some of the key things that we think will go on this year is AI-driven productivity gains, right? Companies are adapting AI at large paces. And I think that this year, of all years recently, companies are going to have to prove that all the money that they're spending on AI is actually going to have to amount to something. It's going to have to amount to higher profits, generally speaking. So if all that goes well, that should be a huge driver of returns this year for the S&P 500, okay? We have policy dynamics being more supportive because the Fed is continuing to lower rates, at least at this time. That's their expectation. And so that will also generate some business activity, especially in some of the areas of the market that have been hit the hardest over the last few years, okay? And then we also have what I didn't coin this term. It was coined by Dr. Ed Yardeni, who's a famous market strategist and economist, what he called a gen-shaped economy, okay? A gen-shaped economy is just this, right? And this is, I think, staggering, and you won't be able to read that. So what I'll tell you is, baby boomers' net worth today, $88.5 trillion, right? And a large party in this room are baby boomers, sorry. but you guys hold most of the net worth in this whole country. It's actually over half of the net worth in this country, okay? Of that, $30 trillion is owned in mutual funds and stocks, okay? $30 trillion. You guys own $30 trillion of stocks and mutual funds. That's a lot of money, right? That's also over half of all the stocks and mutual funds that are owned inside the US, okay? Awesome, right? You know what that means? That means that you can come to awesome establishments like PJ's, and thank you for hosting tonight, and eat. You can go on vacations, you can go on cruises, you can go out to restaurants, you can afford some health care, right? All of these things are huge drivers of the economy, right? So that, even if there are some areas of the economy that aren't doing so well, just that in and of itself, as long as the market continues to go up, people will generally continue to spend money. So even though there are a lot of people that are suffering, especially on the lower income scale, that don't necessarily have the money to go out to eat and stuff, a lot of retired people do, okay? And then the only bad thing is, like I said, higher valuations, which lead to some surprises, especially when we have like headline news and things like that. All right, so I'm gonna stop talking about that. I wanna introduce, you're blank. Eric. Jeez, for Pete's sake.
We talk all the time too, but hey, I couldn't remember my son's name last night, so I know where you are. It's this winter cold.
All right, I want to introduce Eric. 25 years of investment experience with Eric. Provides economic market and investment related analysis for GVA and all of the advisors that are inside the GVA network. He's famous. He's appeared on CNBC, CNN, Money Matters, NPR Marketplace, Seeking Alpha, and CFA Magazine. So he's been around the block a few times. He was an economist at Moody's Analytics, visiting scholar in business business and economics at Ursinus College, chartered financial analyst and charter holder, has a master's in finance from Drexel University's LeBeau College of Business, very good family man, and accomplished marathon runner. So everybody please join hands. Welcome, Eric.
Thank you, great to see you again.
I think this is like Eric's like fourth or fifth time.
Seventh time.
Seventh time, is it really? Wow, seventh time. What is it? Yeah, seventh time to present with us, so thank you for him coming out, and he always draws a big crowd. All right. Okay, so Eric, you ready?
Absolutely, looking forward to it.
Question number one. After several years of persistent recession concerns that never fully materialized, how would you describe the current economic and market backdrop as we head into 2026?
Well, I'd like to say thank you to everybody for having me here tonight. I look forward to our discussion, and like I said, it's my seventh time here, so a lot of familiar faces, and I look forward to talking with you tonight. There's, we went through the survey of people and their views on the outlook for the coming year. And, I share the outlook that Ricardo and Paragon talked about in terms of optimistic but not naive. There is a lot to be constructive about for the U.S. economy and the markets as we go into 2026. There's a lot that can seem complicated about investing and following the economy. But maybe it's the college professor in me, but I'm a huge advocate of keeping things simple and kind of just getting right to the bottom line. And when we take a look at the economy and we take a look at the markets going into 2026, one has to look not that much further than the fundamentals to see good reasons for optimism. So what is the primary driver of stock price returns? What makes stock prices go up? Well, it's corporate earnings and corporate earnings growth. If corporate earnings grow, and we have 155 years worth of history to support this, if corporate earnings are growing, stock prices will rise, all else equal, more often than not. And what is the primary driver of corporate earnings growth? Well, it's GDP growth, it's economic growth. And as Ricardo mentioned in his introduction, the Atlanta Fed, which builds their economic forecasts not on what some economist thinks, but on the data, they're projecting growth north of 5% for the first quarter of 2026. That's phenomenal. You think about, we have a U.S. economy that's over $25 trillion in terms of its annual output, and we're going to grow 5% on top of that 25 trillion. That's a tremendous amount of growth. And for all the companies that operate in this economy, that's fantastic if it can be sustained. So, there are a lot of good reasons for optimism, but to the other point, there's some things we need to keep an eye on. We had the question about what are you most concerned about as we go into 2026? It's a theme that I've probably said when I was out in 2023. I probably repeated it in 2024, and I probably talked about it again in 2025. What is the number one downside risk to this outlook for the economy and for markets in 2026? It's a renewed rise in inflationary pressures. It's what caused the bear market in 2022, and it's something that we really need to continue to keep an eye on. Doesn't mean that it's going to happen, but if we do see it, then that's something that could really derail the outlook.
Awesome, thank you. All right, second question, another easy one. Part of the economy still appears soft, right? A lot of people have called this the K-shaped economy. And for those of you who don't know, K-shaped economy just means that you have higher income earners that are up here and they're able to spend, lower income earners not so much. So you have this shaped kind of thing where you have the haves and the have-nots. Okay. Yet the markets have remained strong. Why hasn't this translated into broader economic slowdown?
Yeah, that's a great question. And it's one of the things that we go back to May of 2023. We come off of a banking crisis, Silicon Valley Bank, Signature Bank, First Republic Bank, some names out of the archives from a few years ago that really had financial markets and the global economy on edge, and it fed its way all the way through to Switzerland because Credit Suisse had to engineer a merger with UBS in order to stave off a financial crisis. Well, one of the effects of that situation that took place in early 2023, we had fiscal stimulus from the Treasury, and we also had monetary stimulus that took place at that time in order to stabilize the banking system. That injection of liquidity came into the marketplace at the very time, and I can remember 3 years ago when I came out to this event, and we were talking about the advent of ChatGPT. And I remember talking to Ricardo, and he was saying, hey, there's this tool that you can put information into, and it provides you all these output, and it's the power of this, and it's going to transform things over the next few years. Well, Ricardo was absolutely right, and this was in January of 2023, because by the time we hit May 2023, the AI boom really got started, and it has continued ever since. And just like the advent of the internet 25 years ago, just like the advent of the personal computer 50 years ago, just like the advent of the mainframe computer 75 years ago, artificial intelligence and AI and what it's going to do to the global economy is going to be transformational. Well, the good news for us as investors in financial markets over the last few years is that this AI boom and all of the earnings growth and all of the economic growth that we've gotten from it has given cover for the rest of the economy. There's a reason why when we went into 2023, 2024, and 2025, you had economists predicting an economic slowdown in the second half of each of those years. Because there's a lot of areas of weakness that have existed in the economy over the last few years. But what we've had is we've had a technology sector that has been more than able to compensate for that weakness. And it's one of you hear about the Mag 7 and all the market concentration. Well, the reason for that is because technology's been doing really well while the rest of the economy has kind of effectively gone through a stealth recession. But the good news as we come into 2026 is that a lot of those other sectors in the economy and the sectors in the market, they are starting to see their economic growth or their earnings growth prospects accelerate at a time when all of this AI capex and all the concerns around, well, can AI continue to grow anymore? We might be seeing a passing of the baton in 2026, and that's a very constructive thing because it's a broadening of performance outside of just technology. We've seen it so far already in year-to-date 2026, and that may continue as we go forward to the next few months, and that's a positive thing.
So can you, I want to ask a follow-up question. So up on the TV above us, there's a graph of a purple line and an orange line. And the purple line above is the ISM services. The orange line above is the manufacturing services. The manufacturing output, the services output has been by and large an expansion, for a long time. Manufacturing or the industrial output has been low, and that's even with all of like the data center building and everything else. Okay, so in your opinion, what do you think can ramp up that industrial output? Because I think you'll agree that in order to get that 3% or 4% or 5% economy that some people are talking about, we need to have industrial output. Yeah. So what are your opinions about as far as what we need to do in order to get that? What do we need to see? Not do, what do we need to see?
Yeah, absolutely. So this chart kind of highlights that whole point about that stealth recession. Here's the economic slowdown that everybody was talking about potentially happening over the last few years. It was taking place in the manufacturing sector. And in some of those more, quote unquote, old economy areas of the United States. And one of the things that, has, if this was the 1950s, if this was the 1970s, this would be a real problem. But it's 2025. And, as Ricardo alluded to, we live in a services economy now. Yes, there's still manufacturing activity that takes place in the United States, and it is still critically important. And it has been a priority under the current administration to try to provide additional support to that manufacturing base in this country. But we live in a services economy now. And services have been growing just fine over the last few years. So the question is, what needs to happen? What do we need to see take place on the manufacturing side in order to get this going? And that can come in a variety of different forms. It can come in the form of lower interest rates, which we've seen since September of 2024, which take anywhere between 9 to 18 months to fully work their way through the economy. It can come in the form of fiscal policy and tax incentives in order to help encourage corporations engaged in manufacturing in order to increase production and increase hiring. And there needs to be some sort of catalyst for demand for different types of manufacturing activity. And when you see the level of capital expenditures that are coming from this AI rollout and some of the feed-through effects, that's likely to be a continued stimulus, even if that level of capital expenditures on the AI headline starts to slow down. It takes a while for that money to make its way through the pipeline. That alone could be a supportive catalyst in order to bring these readings back up into their expansionary levels that we'd like to see.
So, and just so everybody knows, so obviously manufacturing is, you're manufacturing. It's pretty vanilla. What exactly is inside the services, just so everybody knows, other than just like restaurants and vacations?
Yeah, so the services economy is pretty broad. Think about why you're all here tonight. Financial advisory services, legal services, healthcare services, entertainment, travel. So many of the things, we took a look at that chart before that Ricardo showed with the wealth that exists in the baby boomer generation. Part of the outpouring of that is all of the different things that you like to do on a day-to-day basis. Maybe you like to go play golf, or you play pickleball, or you go down to the fitness club, or you go, go on a trip someplace, go out to restaurants. Those are all of the things that you need and want to do in your day-to-day are all the things that make up the services economy. And that, the United States leads the world in enjoying a good lifestyle.
Thanks. All right, so now we're going to move on to the most exciting topic of the night, and that will be bonds. Okay. So believe it or not, bonds are one of the largest markets in the world, much bigger than the stock market, and I would argue probably much more important than the stock market. So turning to fixed income, how should we think about bonds or fixed income going into 2026?
No, I've been enthusiastic about bonds for the last few years. We went through that adjustment in 2022, and man, that inflation that we experienced in 2022 was nasty. And it's not like that inflation went away. The inflation rate came down from 9% to 2.5%, but it still means that prices are growing at 2.5% per year. Those prices that went up a lot in 2022 are continuing to go up, which is, I mean, that's one of the things that causes, the American consumer to feel a level of pain. But what took place in 2022 with that outbreak of inflation, I would argue is one of the best things that we've seen for U.S. financial markets in the last 20 years. And the reason that is because prior to 2022, since the financial crisis, if you were in retirement or you were nearing retirement and you needed to generate income, you couldn't get it from those traditional places that you would normally get it from. You go out and you buy a 10-year U.S. Treasury bond and you would get a yield of like 1%. Thanks, I'll go to the movies by myself.
If you're lucky.
If you're lucky nowadays, I wouldn't even cover that. During the day, get the matinee special. There was no safe yield, so what you had was investors that were forced to go out and buy things to generate income that came with a lot of risk. And that's not a good thing, because if you're in retirement, you don't have an opportunity to go out and try to win the game again if we go through a market correction like we saw, say, with the onset of COVID. Say that extended, that would be a real problem. Well, since 2022, we have seen bond yields rise to historically normal levels. We now operate in an environment where you can go out and buy a AAA or AA plus rated bond and get a nice interest rate for it and actually plan income around it. It is so much more attainable in order to create a portfolio that can generate income in order to support a healthy and vibrant retirement. Now, bonds had a terrible year in 2022. The worst year for bonds in 2022 that we had seen since the 1970s. Things leveled out in 2023. It was kind of a meh year in 2024. Bonds had a good year in 2025. But part of that was driven by the fact that they were starting at a point, they were kind of starting at a low point. And it was a low hurdle for bonds to clear in 2025. So they were up about 6 to 7% on average. One of the things that we should be ready for in 2026 is bond returns that might be in the low single digits. Why? Because yields have come down a lot, which means prices went up quite a bit in 2025. There is that concern about inflation, which could cause yields to come up a little bit, which means prices might go down. But the one piece of good news that you have is that if you own a 10-year Treasury bond, now you're clipping a coupon that's north of 4%. That can offset any kind of price volatility we see in bonds. So it may not be an exciting year in bonds in 2026, but it should be marginally positive, all else equal.
If you buy funds instead of individual bonds, you might be all right in 2026.
Oh, absolutely. Yeah, no, bonds continue to be a great ballast for a portfolio in 2026. And that's where the bond funds come in, is because if you're focused just on the core bond market, well, yeah, I mean, low to mid single digit returns is a reasonable expectation. But unlike the S&P 500, you hear that argument about, index investing or active investing. You want to have an active manager in the bond market. Because to Ricardo's point, the bond market is a lot bigger than the stock market. Go out and take a look. We know Apple. Apple ticker symbol AAPL. There's one stock, and if you want to own Apple, there's one stock to go and buy. But there's a whole menu full of Apple bonds that you could buy. The bond market is significantly bigger, it's significantly more complex, and it's actually really interesting once you get underneath the surface. And you want active managers who can get into all of the different spaces of the bond market to take that low to mid single digit potential return and move it up into the mid to high single digit potential returns, which is a nice ballast for the portfolio because it comes with low volatility and high predictability too.
I'm going to ask you to put your professor hat on for a second.
Love it.
Because I think sometimes people don't understand the relation between yields, treasury yields or bond yields, and stock returns, equity returns. Okay, and I'd like you just for a brief try and explain that relationship so people understand, like, why is it not dangerous, but why can there be turbulence in the stock market if yields go up?
Absolutely, yeah. So it is a really good question around the concept of why is it if yields go down, that means that bond prices have gone up. And why is it when yields go up, bond prices have gone down? And it's just it's one of those, it's like counterintuitive because it's inverse of what like if stock prices go up, your stock portfolio has gone up. A good way to think about it is this, and I'll try to be quick on this. Imagine you go out and you buy a $1,000 face value bond with a 10% coupon, which means $100 coupon for your $1,000 bond. 10% of the $1,000 is $100. If the price of the bond falls by 50%, so instead of being $1,000, people are only willing to pay $500 for that bond. The coupon on the bond doesn't change. It's going to pay you $100 no matter what the price is. Well, 100 divided by 500 is 20%. So if the price of the bond falls from 1,000 to 500, the coupon that you're receiving went from 10%, that $100 on 1,000, to $100 on $500, or 20%. So as the price falls, the yield rises. Now let's flip it around. Let's just say you go out and you buy a bond for $1,000 with that $100 coupon payment, 10%, and the price of the bond doubles to $2,000. The coupon doesn't change. You're still getting $100. 100 divided by 2,000 is 5%. So that's basically why it works that way. When yields go down, your coupon didn't change, the price of the bond changed. And the higher the price of the bond goes, the less percentage is getting paid out in that coupon payment. So hopefully that made sense. So the question becomes, why is it a bad thing for stocks if yields go higher? Why would it be a bad thing if the 10-year, who cares? 10-year treasury. I'm an investor. I'm a stock investor. Why do I care that the 10-year treasury yield has gone up from 4.2% to 5% or 6%? Well, the reason that is because it gives you an alternative that's going to pay you a bigger payout to own the bond as opposed to the stock. So if treasury yields rise, if bond yields rise, that means that stock investors have a greater incentive to say, hey, I don't need to own stocks anymore because look, now I can get 6% in owning bonds. I can get 7% in owning bonds. I'll go back to 1981 when I think I told the story to this group before of going to the Dime Savings Bank on Westchester Pike with my mother in 1981, opening up a Passport savings account and getting a yield of 14% because it was 1981. And we had a big inflation problem back then.
What would you say the average, if you had to guess, yield or interest paid on a bond would be for like the next couple of years? 1 to 2. I don't want to go all the way out to you can't.
No, that's a great question. What should we expect from bonds over the next, I would contend over the next 5 years, is that it's probably going to bounce around anywhere between 3.5% and maybe 5.5%. So yeah, I would say risk bonds right now marginally tilted to the downside, but we're probably going to bounce around between 3.5% and 5% and 5.5% on bonds. That's a good deal on the most part. The stock market can absorb that, and it's a good deal for bond investors because to be able to clip a coupon anywhere between 3.5% to 5.5%, you can plan around that. You can plan income around that. But the last point, another way to think about this, because I saw some hands go up earlier about concerns about the high valuation in stocks. There's something that you can do in order to understand whether you're getting paid more for owning stocks versus owning bonds. You take a look at the 10-year treasury yield. It's at 4.2% right now. And let's just, for the sake of argument, let's just round it and say 4%. You have let's pick out a stock. Let's just say NVIDIA, for example. NVIDIA trades at a price-to-earnings ratio of 40 times earnings. I might be a little off on that, but just estimate 40 times earnings. So PE ratio, price-to-earnings ratio of 40. How can you compare the two? I got a PE ratio of 40 and a treasury yield of 4%. Well, what you can do is you can take that PE ratio and invert it. Take 1 divided by 40, which is that PE ratio, and you'll get a number of 2.5%. That's known as your earnings yield. What that tells you is that investors are going to get paid 2.5% for every dollar of earnings that they invest in NVIDIA. You now have two percentages that you compare against one another. So you hear about stocks being expensive, technology stocks so expensive. What they're saying is that, well, with a PE ratio of 40, 1 divided by 40 is 2.5%. Well, I could get 2.5% earnings yield from owning NVIDIA. I could get 4% for owning a 10-year treasury yield. I could get paid more for owning the 10-year treasury yield. But why do they still own NVIDIA? My question for the group, why do you still own NVIDIA in that case? The growth, absolutely. Hey, 2.5% today, they're growing like crazy. That 2.5% today could be 5% a year from now, 6% a year from now.
With the treasury bonds that you're speaking of, aren't you locked in for a certain time frame with those, though? I mean, I'm just thinking from way back with my dad. He was a big believer in treasury bonds.
No, you're absolutely right, and that's such a great question. Is that, with bonds, typically the way bonds work, you buy a bond, so you buy a 10-year treasury bond, for example, you buy it today, and you hold it until maturity in 2036. And you get your principal back, the amount that you invested, that $1,000 bond I was talking about before, you get your $1,000 back, and you get all of those interest payments along the way. And that's where the active bond managers come in. Because one of the things about a bond manager is that just like stocks, you buy a stock, when do stocks mature? What's the maturity date for stocks? Never. You go out and you buy General Electric. I could go out tomorrow, and buy shares of General Electric, and they would be the same shares of General Electric that my grandfather purchased in 1932 in the depths of the Great Depression. They never mature. I mean, companies can go bankrupt, they can be acquired. So there's no maturity. And people buy and sell stocks all the time. Even though bonds have maturity dates, you can do the same thing with bonds. You could buy a bond that's cheap, and you see that in the high yield bond market, you see it with the emerging market debt, you see it with corporate bonds, you see it with mortgage-backed securities. Active bond managers, and is one of the reasons why it's great to hire an active bond manager, is because they can go into the marketplace and buy and sell these bonds the same way that a stock manager would buy and sell stocks. So it's liquid, absolutely. You could buy a 10-year treasury bond that was issued in June of 2023. It's set to mature in 2023. We could buy it today. Let's just say we go into an economic recession and the 10-year treasury yield drops to 2%. Well, we're going to have a big capital gain on our treasury, those bond positions that we bought, and we'll sell it for a gain and reinvest it in something else. So those same principles apply.
One caveat for our compliance people. Treasury bonds are extremely liquid, most liquid market in the world. Corporate bonds, not as much. Municipal bonds, not as much. And if you have very, very small municipal bonds, even less so, or small corporations or high yields and things like that. So I just want to put that caveat out there.
Yes.
All right. I'm sorry, say that again?
Yeah, no. So the question is, do tax-free bonds work the same way? And the answer to that is yes. And, Ricardo raised a really good point that I just wanted to reiterate. I mentioned I love the bond market. And the reason I love the bond market is because it's really interesting in terms of how differentiated it is. We think about when we invest in stocks, and there's U.S. large cap growth and U.S. large cap value and mid caps and small caps and international and emerging and all these different subcategories of equity investing and stock investing. Well, the same thing exists in the bond market, even more so. You have treasury bonds, like Ricardo mentioned, highly liquid, that U.S. Treasury issued by the U.S. government. You can buy and sell them. There's a full marketplace for that. Corporate bonds, a little less so. Mortgage-backed securities, which, if you want to go back to the financial crisis, what took place during the financial crisis, that was not a stock market problem. That was a bond market problem that caused the global financial crisis back in 2008. Centered in mortgage-backed securities, basically taking people's mortgages, rolling them up together and saying, hey, if you buy this security that contains a whole bunch of mortgages, you can get the the interest rate that those people are paying on those mortgages. There's high yield bonds, there's convertible bonds, there's emerging market bonds. There's all these different categories of the bond market that you can invest in. And one of those is municipal bonds. And the thing with municipal bonds is that the income from municipal bonds are tax-free at the federal level, and they can be tax-free at the state and local level. Now, you get a lower interest rate, but one of the things we talk about, opportunities that exist in the marketplace as we go into 2026, and it was really true in September of 2025, there was a huge dislocation coming off of everything that took place last spring with the market correction, where the municipal bond market got sold off a lot, and there was tremendous value in the municipal bond market. Now, if you go out into your brokerage account and you try to go out and buy municipal bonds, I mean, the inventory is so vast, and there's so many different types of covenants and things that that make each municipal bond unique. Once again, this is where it's good to have the active manager who knows about the municipal bond market and can kind of get in there and differentiate and get you the best municipal bonds in that marketplace, because tremendous amount of value continues to exist in the municipal bond market. Not as much as we saw 6 months ago, but it's pretty attractive right now.
And the municipal bonds too, you have to do a little bit of math to see if it's worth your while, right? Because right now, and this isn't always the case, but right now the average interest rate on a municipal bond is, let's say, around 2.5%, right? Whereas on the 10-year Treasury, you're at 4.2, okay? So in order for you to basically be equaling the 10-year Treasury, you have to be able, I mean, I'm doing stupid math here, but you have to be able to be in like a 50% tax bracket, right? Which, not most people aren't in that. So while the tax-free sounds really good, sometimes it's better off to do the math to say, like, am I better off in a U.S. Treasury bond? Am I better off inside a corporate bond? You might be able to get a corporate bond that's pushing almost 5%, and it's a AA company. It's a very high-quality company, and maybe that's okay if you're planning on holding it, to term or whatever. You don't have to worry about selling it and all that stuff. So it's a case-by-case situation, and as with anything in investing, it depends on what the goal is versus what the liquidity needs are and all that stuff. So it's always good to kind of keep in mind. I had no idea that this was going to be like a 15-20-minute conversation. That's awesome. Bond market. I love it.
And I love those bonds.
All right. So let's get back to valuation. You mentioned valuation a little bit. So earnings are doing well. 15% is planned for 2026 per analyst estimates. But yet we see volatility all the time in the market, right? And we think, like, well, if companies are making money or estimated to make money, why is there all this volatility, right? So you could say, well, like, oh, it's tariffs. We're going to tax Europe because we can't buy Greenland, or oh, it's valuations because the market's so high, or it's the U.S. debt, like, oh, we have so much debt and then nobody's going to buy our bonds. Or consumer weakness because it's a K-shaped economy. We hear all of these excuses as to why there's volatility. What do you think drives volatility in general in the market, and how, as long-term investors, right? And we're not day traders, we're not institutional traders, we're not hedge funds, long-term investors, we're trying to save for retirement, we're trying to, just live our lives. How should we view those things?
Yeah, no, absolutely. The first thing that I'll say, volatility is a good thing. Volatility in the market, so your price swings. You think about this week, for example. We have the Martin Luther King holiday on Monday. We come back to markets on Tuesday, and the S&P 500 is down 2% on Tuesday on geopolitical news. Well, how did it do today? It was up 1.5% today on geopolitical news. So, we're going to see volatility, and one of the things that I agree with the Paragon forecast, I think we're likely to see increased volatility in 2026. And that's really likely to be driven by two factors. One, because stocks are pretty expensive. If you take a look at stock valuations historically, we're currently trading at about 28 times earnings on the S&P 500. The PE ratio is around 28. Historically, that's very expensive. The historical average PE ratio on the S&P 500, if you go back 155 years, is about 16.5 times earnings. Now, the market's changed a lot in the last 155 years, so maybe we go with a more relevant time period since 1987. Why do I pick 1987? Stock market crash of 1987. What did we learn coming out of the stock market crash of October 1987? No new taxes, yeah. So George H.W. Bush, rude those words. The Federal Reserve will step in and provide liquidity in order to support financial markets. That was under Fed Chair Alan Greenspan, and we have seen that time and time again over the last 39 years. The Federal Reserve will be there to save the day, to inject liquidity. It justifies a higher valuation for stocks. The average PE ratio for stocks since 1987 has been 22 times earnings. With that being said, we're trading at 28 times earnings today. So when the stock market is more expensive, you're going to get more volatility, because when things start to become unstable, people take a look and say, hey, getting back to that whole Apple point or the NVIDIA point I was making earlier, hey, I can go put my money in the U.S. Treasuries, which are a lot safer, and get that guaranteed coupon.
Question, because we're gearing now, S&P's like 33% technology.
Yes.
It's got the hyperscalers and all. Doesn't that, the argument would be the PE values are going to be higher because we have a lot of tech companies that are taking, what's your feel on that?
That's absolutely right. It was a great segue, because that was the next point that I was going to make, which is perfect, is that one of the reasons that the S&P 500 is more expensive now at 28 times earnings is because about 40% of the S&P 500 is made up from the tech sector, which is experiencing phenomenal growth, which kind of justifies that higher stock valuation, because NVIDIA is not the only company that's experiencing phenomenal growth. The tech sector in general is forecasted to rise by as much, grow earnings by as much as 40% in 2026. I mean, that justifies a 28 times PE ratio. The other thing that's notable about it, though, is that if you take out technology, if you take out communication services, which is basically Alphabet, which is Google, Meta platforms, which is Facebook, which is really tech. It used to be in the tech sector, and until they carved them out because AT&T and Verizon were lonely in telecom services, and they made communication services. If you take out consumer discretionary, which is Amazon and Tesla effectively, and then a bunch of media companies and a bunch of retailers, the S&P 500 is only trading at 18.3 times earnings. Outside of the technology sector, the U.S. stock market's actually cheap right now relative to its history. And in an environment where we talk about kind of a stealth recession underneath the surface, these companies in these sectors are experiencing accelerating earnings. It could be a situation where even if the AI trade hits a wall and you turn on the television and you see, oh my gosh, the S&P 500 is down 2% today. But then you go and you take a look at your portfolio and you say, well, my portfolio is down a lot less than 2% today, because there's 493, the Mag 7, it's more than 7 stocks. There's 493 other companies in the S&P 500 that might be doing just fine that day, but you have these massive companies that have maybe cooled off a little bit. That's a good type of broadening that's taking place. And that's something that we should expect to see, is that even if the headline index is volatile and struggling, that there may be a lot of stocks underneath the surface that are doing well.
What you're saying is the headlines may be lying to us.
Not lying, but they may be overstating. That a market that, like you'll see the NASDAQ down a lot and the S&P that's down a lot, but then you get underneath the surface and you say, consumer staple stocks are doing fine, healthcare is up today, and it's just because so much has been concentrated in the tech sector that it kind of amplifies what's otherwise going on.
Your personal portfolio may not be down as much as the index.
Exactly. That's a phenomenon that we could reasonably expect to see in 2026 and 2027, where if the AI trade hits a wall, or if the AI trade's having more volatility, there's so many other sectors of so many other sectors in the stock market where that money could be flowing that are doing just fine. We saw the same thing in 2022.
So, and a lot of those sectors depend on energy.
Yes. Yeah.
And the reduced cost of energy across the world.
Right.
is
Absolutely.
going to be huge.
Yes. Yeah. Absolutely. Yes. And that's, You know, I think that's going to, what you just said is going to be a key theme for the markets. It's already been a key theme for the markets, so it's in 2025. As we go through the next 10 to 15 years, not only energy, but commodities, rare earths, you know, nickel, lithium, all of these raw materials that are going to be required to power all of this technology and just power the global economy in general. Not to mention the growing trend that we've seen. 2022 was an inflection point, but we had been building up to it for a while. It's kind of pivoting to the geopolitical side of this. We lived in a world from 1991 up until 2022 that was globalizing. You know, it was a global economy that was all working together, and oh, well, you know, like the Soviet Union has collapsed. Let's bring Russia into the global capitalist system, and oh, well, China, they want to play nice. Let's bring them into the global capitalist system, and that was the 1990s, and that was the 2000s, and even the 2010s. Well, as we continue through the 2020s, we're moving from a globalization world to a disglobalization world. It's not as though, you know, we're contracting in that way, but we're trading less with our partners around the world, and we're moving more towards a world of spheres of influence, where, you know, it's behind the whole story that we're hearing about with Greenland in the news right now. It's that, you know, the importance not only of oil and energy, but also those raw materials are going to be increasingly critical over the next 10 to 15 years.
True or false? The S&P 500 was invented for the average investor to be able to invest in.
I'm going to venture a false on that.
Thank you for that. So kind of getting back to you, you asked a question that kind of stuck with me. It's not that the headlines are lying to you. It's that what we're used to having as the headlines as the S&P 500 or the Dow or whatever, right? Being the headline news, oh, the S&P was down 2%, or the S&P was up 1%, or the S&P was, you know, whatever, right? Whatever the case may be. The S&P 500 was not intended for the average investor to look at and be like, oh yeah, that's my investments. It's just the largest 500 companies in the US. That's it. That's all it is, right? With some profits and some other caveats in there as well, but for all intents and purposes. So the idea that someone should just blindly buy an index because it happens to be a large index doesn't necessarily make it right, and doesn't necessarily make it suitable, right? That's why there's dividend portfolios. That's why there's growth portfolios. That's why there's core portfolios. That's why there's defensive portfolios, right? Because everybody has different needs, right? So when someone looks at the news or the business channel or whatever the case may be, and they hear this index is up or that index is up or, you know, whatever, it shouldn't matter to them, right? Because they should be invested in a way that's appropriate for them, right? Whether it means that they hold 40% in bonds, they don't hold any bonds, maybe they're in 60% bonds and a dividend portfolio or something like that. That's a conversation between, you know, that person and their advisor, or if they're doing it themselves, a conversation you need to have with themselves. You know, hopefully they're not being recorded because, yeah, right. But so that's like, those indexes are just there, and somehow they've become a staple of just how we report news and how some fund managers, you know, peg their benchmarks. And I'm not saying it's not a good thing just to kind of have an eye on it and see what that's doing, because I mean, realistically, like, you know, your Googles of the world, your Amazons of the world, your Metas of the world, these are gigantic. These are the largest companies in the world, right? Not even just in the US. I mean, these companies are big enough to buy whole countries, no pun intended. So so it is there for a purpose, but it doesn't mean that it's an appropriate investment for everyone across the board. Okay, so I just kind of want to put that out there. So it's not that we're like being lied to. It's just a matter of like, it may not apply to us, right? Like, not all the news really necessarily has to apply to us. If there's a problem somewhere, you know, in Venezuela, it doesn't necessarily like apply to some guy that lives in Milwaukee. Like, you know, maybe not. I don't know. It doesn't, not really, right? So at least we hope not. All right, so I want to move on to our final question here, okay? And this is hopefully your favorite question, all right? What risks stand out heading into 2026?
Okay, so risks in 2026. We start off the year, we have the president of Venezuela that's removed. We have some saber rattling around Greenland, of all places. We have protests that are taking place in Iran. And it's really tempting to think, like, okay, and a lot of hands understandably went up to say, you know, the geopolitical environment is likely to be the primary downside risk for financial markets as we go through 2026. And my answer to that would be, could it lead to some short-term volatility where we get a couple days where the markets trade off because of, something that's happening in the market trading off on Tuesday because there's uncertainty. How does this Greenland situation play out? And, are we compromising our relationship with our NATO allies in Europe? The markets have historically always found their way to work through those geopolitical uncertainty and move to the upside. These events have taken place all through history, and I know I've talked to this group in the past about 9/11. We had the terrorist attacks in 9/11, 2001. The stock market was closed for an entire week. It reopened and it traded sharply lower for 5 days after the reopening on September 17th. The first 5 trading days, the S&P 500 traded lower, but then it started to rally. And by October 11th, 1 month after the terrorist attacks of 9/11, the U.S. stock market was trading higher than it was before the attacks of 9/11. You go back to World War II, in April of 1942, World War II was on at that point. The U.S. was, we had been attacked at Pearl Harbor. Our involvement was inevitable. And we had no idea how that was going to play out around the rest of the world. Yet in April of 1942, the stock market bottomed, and for the next 3 years, through the end of World War II, the stock market moved to the upside and was significantly higher by May of 1945 versus where it was in April 1942. If the stock market can weather those 2 past geopolitical events, it can certainly weather some of the events that are taking place today. The key here, I could even make a case that some geopolitical events, and because the market has no feelings, the market is a cruel and just uncaring creature. If the U.S. stock market's getting liquidity, it doesn't care what's going on. And if there's a geopolitical event that takes place that's going to cause global central banks to inject liquidity in order to stabilize the global financial system, U.S. stocks will rally on the news because they don't care about anything other than the things that feeds it to make it go higher. Which brings me to the key point. What is the primary downside risk for the markets as we go into 2026? And it's the same risk that I've been saying since the summer of 2023. It's a renewed rise in inflationary pressures. Inflation is the biggest thing that we need to be watching as we go into 2026. And there's a key reason for that. We'll go back in time to history. 1972. Does anybody know how we referred to the stocks that were leading the market in 1972? That name is a rhyming name.
The Nifty 50?
The Nifty 50, absolutely. What characterized the Nifty 50 stocks? Hey, you own these 50 stocks. It doesn't matter how expensive they are. It doesn't matter that they're trading at 28 times earnings or whatever the price to earnings ratio was on those stocks at the time. You just own them and you forget them. You don't have to worry about it. Valuations don't matter. Well, they didn't matter until they did, and a lot. Because in 1973, we had the OPEC oil embargo, and all of a sudden we had this massive inflationary outbreak, and those stocks didn't really do very well through the remainder of the decade. The problem with inflation is that if you go into an economic recession, what does the Federal Reserve do? I'm sorry? Pump money, quantitative easing, lower interest rates. We got to put more money into this thing to make that recession go away. It injects liquidity. It puts more money into the markets, and if there's liquidity in the markets, that's going to help push stock prices higher. But if you get an outbreak of inflation, and I'll put my professor hat back on here for a second, an outbreak of inflation, too much money chasing too few goods. What does the Federal Reserve, what does the government theoretically have to do? Although you find me a politician that's going to raise taxes in Washington right now, and like, you know, it's like an endangered species. So it's going to come from the monetary policy side. The Federal Reserve has to raise interest rates. They're taking money away from people. They're withdrawing liquidity from the financial system. That's the primary reason why we had the bear market in 2022. But fortunately, the inflation problem went away pretty quickly in 2022. If we get an outbreak in inflation in 2026 or 2027, where the Federal Reserve has to raise interest rates, or worse yet, we get an outbreak of inflation in 2026 or 2027, and the Federal Reserve doesn't raise interest rates in order to combat the problem, well, stocks aren't going to like that at all. And the economy won't like that at all. So that continues to be the number one downside risk, an outbreak of inflation. The good news is, as we start off 2026, inflation expectations are anchored at about 2.2 to 2.4% average inflation over the next 5 years. The stock market will love that all year long for the next 5 years if we get that, because it is low, it is predictable, and if you're a company that's generating 10 to 12% earnings growth with 2% inflation rate, you're making a lot of money on an inflation-adjusted basis. So great news as we go into 2026, but we got to keep an eye on it as we continue through 2026 to make sure that that continues to not be an issue.
Okay, so one last follow-up question, and then we're going to open up the floor for question and answer session or whatever. What exactly can drive up inflation, right? So we hear like, okay, we've been hearing inflation since 2022, and I know that that's a concern of yours and mine. But what exactly, inflation's been fairly normal for the last 2 years or so, about 2.5% or so, right? And between 2 and 3%, everybody's making money, and we're all happy, right? Generally speaking. What can drive up inflation to a point where all of a sudden now it's dangerous for stocks?
Okay, that's a great question, because one of the things that's been true since the inflation outbreak of 2022, services inflation has remained relatively hot. You know, we've had services inflation that's been anywhere, it's been north of 3%, it's been as high as 5%. It's not getting any cheaper to go out to dinner. I mean, you go out to a restaurant, you open up a menu, and you're just like, holy crap, this stuff's expensive in the menu. You go to the movies, it's not a cheap night out anymore. Not that it ever was, but man, it's gotten expensive. Services inflation has been real and continuous ever since 2022. What has caused inflation to come down has been the drop in goods inflation. Automobiles, appliances, the things, durable goods and non-durable goods, clothing. Energy's been a part of that. Now that energy's not in the core CPI, but it is a key factor. One of the key factors to watch is the oil price. I mean, it was true in the 1970s. Are we as oil dependent as we were in the 1970s? Absolutely not, but it still matters. So services inflation has remained hot. It's never really, it's cooled down somewhat, but it's remained hot. We've had goods deflation in 2023 and 2024 and 2025 up until a couple months ago. Starting in about the middle of last year, goods deflation started to turn into goods inflation. And when we got to the peak of inflation in 2022, goods inflation was around 20%. Well, it then came down and it was negative for a while. Now it's about 1 to 2%. And kind of keeping an eye on things, if you start to notice that the price of cars are getting more expensive, or the price of appliances are getting more expensive, or the things that you're going to buy and keep around for a while, or maybe the things that you're going to buy that you use that you can drop on your feet that you might not keep as long, if those prices really start to go up in a meaningful way, then we got a real inflation problem on our hands. So another thing to keep an eye on too, if the economy is running too hot, we're hearing, we talked at the beginning, great economic forecast here, earnings, GDP growth north of 5% in 2026 Q1. Well, if the economy is growing so much and people start making more money and we start having too much money chasing too few goods, that can also feed that inflationary beast. We're not seeing it yet, but it's something we got to keep an eye on.
Thank you very much, Eric. All right, so we're going to head into Q&A. Hopefully you guys have a bunch of questions for us. We're willing to answer just about anything, and if we don't know the answer, we will make it up, okay? So, no, we won't.
Feeling my secret.
But before we do, I just as much as Eric loves the bond market, I love the stock market, and not because the stock market generally goes up more than it goes down, thankfully, but also because it's a way that we can describe how we view the world, right? And you can kind of do that with the bond market as well. But with the stock market, you can really do that, right? You can really decide where you want to put your money and what companies you want to put money behind that you actually own. And I never want clients to forget that, right? Is that you own these companies, you're a shareholder of that company. And that's a thing for me that really strikes the biggest difference between owning a stock, or owning a company, right, versus owning a fund or an ETF or mutual fund, whatever it may be. And we use mutual funds and ETFs and stocks, we use all that stuff. But there's something to me that's almost like, adds a little bit of pride to be like, yeah, okay, I'm walking around with an iPhone, I'm a shareholder of Apple, right? That's awesome, right? Okay, I'm going to buy an Apple product, that's fine because some of that dividend's coming back to me and some of the earnings are coming back to me as a shareholder, right? Yeah, right. Mine as well. The packages from Amazon coming over at my house are every single day. Okay, so but everything. Starbucks. You feel a little bit guilty about spending money at Starbucks and a $5 cup of coffee. If you own the stock, then you don't have to feel so guilty. You're owning a portion of that stock. You're getting some of that dividend. You're getting some of those earnings. So that's the difference, right? It goes beyond politics. It goes beyond emotion. It goes beyond everything. Because at the end of the day, when you own a company, you own a share of the profits, of the cash flows, of all the things that are entitled to you as a shareholder of that company, right? Yeah, no, absolutely. So if you're clients of ours, then you own, then you probably own equities. So that's great. But that's like our kind of like rule book that we use, and it's very difficult to find advisors that will do that for clients, anymore. So that's kind of like my 1 minute commercial for us. So Q&A. Who's got questions? Belinda, I saw you first. Then we'll go over to you.
You were talking about goods inflation. Goods inflation, or to keep it at bay, would be great if we had a lot of the goods that we needed that were built and manufactured here in the United States. But what happens when so many of those things, like appliances, come in from outside that are suddenly affected by the tariffs? The tariffs are on the country, but we end up paying for it.
Right.
We, the consumer,
Absolutely.
inherit that tariff.
Yes. Yeah, so that's a really good point and it's one of the things that had the market so on edge, 10, 11 months ago. The market was already falling before Liberation Day, quote unquote Liberation Day on April 2nd when those tariff rates were announced. But it is one of the things that needs to be watched from a geopolitical standpoint. As we move from one of the reasons that we had disinflation for 40 years from the early 1980s all the way through to the early 2020s was because of globalization. You could, engage in, production where the lowest cost producer around the world could focus on producing the goods. China could produce the world's goods at the lowest possible cost, and it would keep inflation low. Well, that world is now changing. And, that economic reality is being recognized by global leaders, and, who's producing what is, currently in the process of shifting. Ideally, we bring production back to the United States. That's great from a national security standpoint. It's great from an economic stabilization standpoint. But our labor costs are often higher in this country. They're not as high as they used to be relative to the rest of the world, but our labor costs and our production costs tend to be higher in the U.S. than they are in other parts of the world. So that's one of the things that we need to be prepared for, is that, prices could be sustainably higher And those prices are likely to be passed along to the consumer, at least to some degree.
How much of a lot of companies, they say 8 a lot of the time, is that true?
That's the thing, is that, you know, the tariffs haven't been implemented like in isolation and all else equal, because there's also been tax law changes, corporate tax law changes that have taken place along with that have kind of helped offset that. The other thing that's a key too, and we've seen this historically with tariffs, is that, and we saw this last spring, the markets were uncertain because they didn't know what the numbers were going to be. And then they saw those Liberation Day numbers and they were just like, wait a second, this is a lot higher than I thought they were going to be. Once they got down to the numbers that Wall Street expected and the companies expected, companies can make that one-time adjustment and say, okay, if the tariff rate is 10% or if it's 15%, we can factor that into our production. We'll pass along some of the costs to the consumer. We'll eat some of the costs. We'll set new profit margins. We'll be on our way. Uncertainty around tariff policy is really where it gets difficult. So, but
do you think that bringing industry back to the United States, that we could be competitive in the world, like, as far as you're selling our goods to other countries and stuff like that? Do you think that companies are interested in doing that, or they're like a little cautious?
Ooh, can I take that?
absolutely, go ahead. I
Okay.
can see your itch. So I'm going to turn it over to you.
So this is kind of like a baby of mine, right? So when I think of manufacturing in my mind, did anybody ever watch Roseanne, like way back when? Not the new one that nobody watched, but the one back in the day. She worked like in a factory, right? And she, like, I forget what it was, made widgets, right? And we think of, like, you know, these people like the 1930s or whatever, just going like all greasy and everything else, building stuff. That is not manufacturing today at all. You go to China, which is the manufacturing hub of the world, and it's not that they have, like, you know, a billion Chinese people sitting there, like, you know, like doing little sledgehammers and like building wash machines or whatever the case may be, right? It's automated, right? It's fully automated. These are like factories that are like, have like maybe like 100 humans in it and hundreds of thousands of square feet of robots, right? For lack of a better word, right? So that's manufacturing of today, right? And there's tons of technology that allows to do that, right? You have companies that specialize in making things that are like, they call them Internet of Things, where you have one component talking to another component on the other side of the factory. You have troubleshooting that's happening before the technician even gets there, so they're armed with more information by the time they get there to figure out what's going on, so they can get things back online as quickly as possible. It's a beautiful thing, manufacturing nowadays, with automation and things like that. And to be honest, like all of your college courses, and you could probably agree, they all talk about that hierarchy of needs. Was it Maslow's or something? Yeah, hierarchy of needs. And they're always talking about that guy that's sitting there going like this all day, you know, and they get like, you know, the elbow problems and the shoulder problems because they're doing this continuous motion all day long, right? And it solves that problem, right? It solves that problem so that the jobs then transform from some poor guy going like this all day to now the jobs transform into like a higher tech, you know, repairman job, right? Like my son, you know, is tired of me telling him to join the robotics team because he should be a robot repairman. Like, as George Jetson as that sounds, like that, like I really believe that that's the job of the future. You have to know how to work with technology, right? Right. That's manufacturing of today. So there is no reason, as your question goes, you know, yes, we can build things here in the U.S., and yes, we can export things to other countries because we have the ability to have that, you know, automated technology here, building most of the products that people need and having that infrastructure here in the U.S. And a lot of the tax benefits that were added to help offset some of the tariffs that were put on are around that, where, yeah, okay, you build a factory here, you buy all the stuff that needs to go inside that factory, they will give you a tax cut that year to be able to do that.
The housing market, with lower rates, what do you see for 2026 in the housing market impacting?
I'm just going to repeat the question real quick so that they can hear. So the housing market, and what do you see in the housing market with lowering rates in the future?
Yeah, one of the things that has been a challenge for the housing market for the last many years, and I mean, it was really a byproduct going all the way back to the end of the financial crisis, is that there were so many home builders that got burned with overproduction and excess supply of houses. That we have been in a chronic situation for years where demand has exceeded supply, and that's one of the reasons why we've seen home prices going higher. That is starting to balance itself out a little bit more, where we're seeing increased building activity. One of the biggest issues that we have is that we still have a supply and demand imbalance. The demand for housing continues to exceed supply. And that's because nobody wants to move. For years you had people that were refinancing and refinancing and refinancing. Most of the country, and it's becoming less with each passing year, but a good portion of this country has a 30-year mortgage at 2.75%. They say, hey, let's think about moving from our house and maybe moving to another place. They go out and they do it, and they say, well, I downgrade if I'm going to move. So, but one of the things that we're likely to see going forward, lower interest rates will help, particularly if it lowers mortgage rates, because it will make it more palatable for people who are in their existing home to consider moving. Another reality that's setting in is that the longer that we move away from that low interest rate environment, there are fewer and fewer people that, and it's still a large percentage, but fewer and fewer people that are riding off of that lower mortgage rate. And they're also looking at a higher home equity line of credit and home loan interest rates that they might have taken on in recent years. So those forces, increased supply, lower interest rates, and just people not being as locked into those low mortgages as they were, are all things that are likely to bring more balance to the housing market as we go through 2026 and really the rest of the decade.
Good.
One of the things I didn't hear on the discussion this evening was the relationship of the monetary policy of the United States against their federal debt and unfunded liabilities.
Mm-hmm. Okay.
In the future.
Right.
And I don't know how that relationship is going to work itself out. The monetary policy and the debt and unfunded liabilities.
And just as a follow-up question to your question, do you have concerns about monetary policy in the United States going forward?
I think that they're a little disconnected.
Okay. Well, just yeah. No, that's a good thing. And one of the things about gold and silver, the price performance on gold and silver has been phenomenal the last few years. One of the things that I would caution, I was reading an article in the Wall Street Journal tonight before coming here about, the 5 reasons that gold prices are going higher here in 2026 and 2025. I don't know that I agreed with any of the 5 reasons that I saw in that article. There's other forces that are likely at work. I mean, they're likely a contributing factor. The counterpoint that I would make to that Wall Street Journal article is that all of those forces were true in 2013, and gold prices dropped by like 20-30% that year. So there's other factors that are likely at work. Gold and silver, they are a reflection of liquidity. Indeed, they're a reflection of liquidity. They're a reflection of demand, and central banks are buying more gold. But history has shown that gold and silver are also an indicator of concerns about potential instability going forward. Geopolitics, fiscal economies around the world, about uncertainty and potential instability. That instability could be inflation. That instability could be, potential geopolitical conflict. It could be unforeseen concerns. So that is a reflection of uncertainty, and we should pay attention to that. And that's a diversion from the monetary policy question. It's interesting how the search for the new Fed chair has evolved. We've had Jay Powell, who's been chair of the Federal Reserve. He was reappointed, by President Trump in his first administration. Clearly, he's not going to be reappointed here in May. There's 3 primary candidates.
That's my wild card.
What's that?
That's my wild
Your
card.
Okay,
That's my
so
wild
do you want me
card.
to keep that in the bank?
No,
then?
no. But that would be. I thought about that.
Why don't I turn it over to you? You can tee it
I'm
up.
just saying. I thought about that. I'm like, wouldn't that be the funniest thing in the world if he was like, "Oh yeah, I renominate Jay Powell."
Could you?
that would totally flip everybody's
Door
world
number
upside
4,
down. Yeah.
He comes rolling out. It's been interesting, the evolution. There's 3 candidates. You know, there's Chris Waller, who is an experienced monetary policy maker, you know, served on the Federal Reserve, on the Board of Governors. There's Kevin Hassett, who's, you know, in the Trump administration. And then there's Kevin Warsh. And as we sit here today, Kevin Warsh, if you take a look at the prediction markets, Kevin Warsh is considered to be the highest probability of being named the chair of the Federal Reserve come May. Now that could change because Kevin Hassett had like an 80% probability a couple months ago. Kevin Hassett? Yes, it was the dinner last week where he said, hey, I think we're going to need to keep you around here in the administration, which was and that really shifted the prediction market. So right now it looks like it's going to be Kevin Warsh. Now, for those who have followed monetary policy going back to the financial crisis, one of the biggest concerns that the markets and financial news has expressed about, okay, we install a new Fed chair on May 15th, and there's an interest in the current administration to lower interest rates. So they're going to install a new Fed chair on May 15th, and they're going to just start lowering interest rates, and that could lead to market instability and potential inflation. Well, if you wanted to appoint a Fed chair that was going to start to lower interest rates at will coming into the role in May 15th, Kevin Warsh is the last guy you want to nominate to the Federal Reserve to be chair to do that.
He's a hawk.
He's hawkish. This is a guy back in 2011, he left the Federal Reserve in disgust because he was so frustrated with Ben Bernanke and the Federal Reserve at the time because they lowered interest rates to 0 and they were doing quantitative easing, and then they did quantitative easing too. And he left because he was like, this is not what we should be doing as the Federal Reserve. We shouldn't be involved going beyond our dual mandate of price stability and full employment. And he was hawkish. He was like, we shouldn't be doing QE. We should start raising interest rates in the early 2010s. And he's never really deviated from that view all that much. He has been perpetually relatively hawkish when it comes to monetary policy. So if this is the person that is the most likely appointee to the position, what is that signaling in terms of what we should expect from the Federal Reserve past May 15th when the new Fed chair is appointed? Well, a first indicator that we can look at is the Treasury Secretary of the United States. Trump's first term, he appoints Steve Mnuchin as Treasury Secretary. He serves 4 years, and Trump pretty much leaves him alone. You look at the second Trump term, he appoints Scott Bessent as Treasury Secretary, and if anything, President Trump takes the counsel of Scott Bessent in terms of how to manage the economy. He looks to his advice in terms of how to manage the economy. We shouldn't be surprised that once the person is installed in the Federal Reserve, that as long as they're reflecting the institutional objectives that the current administration would like to see from the Federal Reserve, that they will be left alone to do what they need to do. Now, that's one view, and there's differing views out there. But if you're going to appoint somebody like that, the question also becomes is that why would you appoint somebody who is hawkish to the Federal Reserve at a time when the administration keeps talking about, hey, we want you to lower interest rates to stimulate the economy? Well, we have a potential inflation problem that's building. I've talked about the number one downside risk to the economy and the markets is inflation. Well, if that is the number one risk that hasn't manifested itself yet, but it starts to become a problem, you want to have somebody in the position who has credibility with financial markets to be an inflation fighter. And that's basically what defines Kevin Warsh. He is hawkish and is somebody who has demonstrated himself to raise interest rates and take action in order to control any type of inflation outbreak.
Are they leaning towards him?
That he's the most likely choice. And it's really more of an expectations game, one could argue. We're worried about inflation. How do you help keep people not worried about inflation? Well, you install a guy who's got a really good track record of being willing to fight inflation if need be. So it's kind of managing expectations around that. So
the other day, Lutnick was on CNBC, and he said that he thought the growth rate for the first quarter, he was pretty sure was going to be 5.
right.
How do you reconcile Lutnick saying 5% for a growth rate and Trump with his position of lowering interest rates? They're so at odds.
So I'm pretty hawkish myself, so this is my opinion, and others will differ. I'll go all the way back to September of 2024. I don't think the Federal Reserve should be lowering interest rates at all. I mean, you have an economy that's continuing to grow at a solid rate. Inflation pressures are in check. I'm somebody who's more of an adherent to keep the dry powder. Keep interest rates where they are and save those interest rate cuts until you absolutely need them. But there's certainly that want to stimulate the economy further. But you're right. If you have an economy that's growing at 5%, that goes against the textbooks of why you would want to lower interest rates. That kind of gets into more of the hawkish view would be that's unnecessary. The dovish view would say, we have that flexibility. Inflation rates continue to be low. The economy is growing strongly, but there are pockets of weakness. We could have even more prosperity. Would be the counter arguments, but that would be the dovish side. But I'll give you a chance to chime in because I think What's that?
Warsh won't be the guy.
To lower interest rates? No, I agree.
To get elected. To get elected, you mean? You don't think Warsh will get elected? As appointed, I should say.
Trump having Warsh as one of the chief.
Yeah.
Knowing what Warsh's position.
Right.
If he's worried about inflation, if we do get an inflation outbreak, then what Trump can do and be like, see, it was that Powell guy. But I got the guy in there now that's going to be able to fight the inflation problem.
I think I tend to agree with you personally. I think Warsh is a little bit of a like a Trojan horse kind of thing. I would lean more towards if I were this is my personal opinion. I know absolutely nothing at all, but my personal opinion would be I would either lean towards Kevin Waller, who's in the Chris Waller, who is in the Federal Reserve right now and seems to have a decent amount of consensus and seems to have been pretty accurate so far with his macro predictions of the economy.
He's a very credible guy.
So that if you were looking for a credible person, that would be one person I would look at personally. And the other one, I think Rick Reeder, who's kind of like, I think he's got like a 15 or 20% odds of getting it right now. He would be another one that I would look at. Only because he understands the bond markets really, really, really well. If nobody who doesn't know, Rick Reeder is like the bond market manager for BlackRock, who happens to be the largest financial institution like in the entire galaxy. Okay, so I want to steel man something really quick. I love to steel man stuff. And it's not because I don't agree or I agree or disagree. I like to argue with myself quite a bit. Okay.
So it keeps you up at night. I argue with myself all the time.
But I feel like this is a healthy exercise to do, because if you're going to make a decision as to how to best put investments to work, you have to be able to look at both sides of an argument and try and figure out which one makes the most sense for the situation that we're in. So I like to argue with myself all the time. Okay. So I think that there can be, or I will argue that there can be a 5% GDP print and still not have high inflation. And here's how I think that it can happen, okay? You can have a 5% GDP, and I said in the beginning, I don't know if you heard or not, for Q4 2025, right, the Atlanta Federal Reserve is predicting right now a 5.4% GDP print year over year. 5.4. Today, I just checked before I came over here, okay? The reason why that is because exports, right, have been a large driver of that GDP print. It's not because we're producing a ton of stuff and selling a ton of stuff here in the U.S. It's because we're exporting a lot of stuff overseas. Okay. One way where there can be a large GDP print, right, and not have inflation is if we continue to start to export things overseas. Okay, one of the things that we saw over the last 12 months, 14 months or so of the Trump administration has been deals with a bunch of other sovereign nations and companies to make investments here in the U.S. Okay, so if money is coming here in the U.S. and we're exporting some products overseas, that's an added benefit to the GDP here. And it may not necessarily mean a rise in prices here in the U.S. It could be a rise in prices overseas, right? So that could be a way where we can have a 5, even a 6% print in GDP and still have a 2.5, 2.6, 2.7% print in inflation. Because we're pushing our products overseas.
I think it's a great point. No, I completely agree.
So
Yeah,
that's
we're exporting the inflation.
Because we're exporting the inflation, exactly, right? That may not be great for Europe. That may not be great for Japan. That may not be great for Taiwan. That may not be great for some of these other countries. But but for here in the U.S., that could mean high GDP, lower, normalized inflation. Okay, so I'm not saying that's what's going to happen, but that's an argument that I can make with myself, saying that this is what I can see happening. There is a possibility of that. Okay, and that may be like the administration's rolling around right now, and I watch, I think, just about every single interview with everybody within the administration because, it has clout. Like, this is what they're doing, or hopefully you think this is what they're doing, so you want to have a kind of an ear of what's going on. And they're all running around saying 5-6% GDP for 2026, right? Does that mean that all of a sudden that, I think to have a real 5 to 6% GDP print in the U.S., right? Almost every living soul in the U.S. would have to be employed, right?
That's robust.
Yeah, I think you'd have to have a back down to a 2.5 or 3% unemployment rate or something like that, and then there probably would be some inflation because all of a sudden everybody and their mother is employed and everybody's buying stuff and spending their money, right? But you can have a 5% or 6% print if you're exporting everything overseas. Okay, so that's one way to do it. The other way to do it too is, as we kind of talked about before in one of the slides back, where you have this real difference between services economy versus manufacturing economy. Okay, if we can lift the manufacturing economy while keeping the services economy, normal, right, average as it is now, that's also another way we can lift GDP on average and not necessarily increase the inflation report, which can also go back to the exporting our goods overseas, right? So if we're inviting companies to bring manufacturing back in the U.S. and we're using modern technology to actually create these manufacturing facilities with automation, robotics, and things like that, and we're employing higher paid jobs to keep all of these things running and keep everything greased up and nicely and all that stuff, it's a way to be able to bring GDP back in the U.S., export more goods overseas or even here in the U.S. or whatever without necessarily making things more expensive. Okay, so that's one way where we can have higher GDP but still a relative inflation. That's why I'm not I'm not really expecting him to get appointed because, we may not necessarily need to have such a hawk there to be able to keep interest rates down. Because one of the things that we do need in order to be able to create longer-term GDP prints, right, is we need to be able to get interest rates to a level where it makes sense for an industrial company to invest here at home, right? Because doing that with 8 or 10% interest rates just ain't gonna happen, right? So if you figure, if rates are at 3.5 or 4%, your normal business loan is gonna be at 8% or something like that, which it's gonna be a little bit tougher than to do when interest rates are at 3 or 2.5 or whatever the case may be.
Yeah, but you can fix a lot of that with tax policy too.
You can, but tax policy could be relative to whoever's in power, right? Like all of a sudden, so another thing that I'll point out is that we also have a midterm election year, right? So within a matter of 10 months or so, we could have a completely different Congress makeup, right? So right now, the prediction markets have the House of Representatives being led by the Democrats and the Senate being led by the Republicans. That means that Trump's last 2 years, absolutely nothing gets done, right? So whenever all of those tax cuts expire, they go away, and all things revert back, right? And that just, that means that everything goes back to the way it was a couple of years ago. So there's a lot at stake. Tax policy sometimes is not permanent enough, right? As we saw this year with all that, tax stuff.
We talked about a little earlier the AI. So, as an HR professional, I can tell you that HR has been a big giant bust for us, right? It has not lived up to the hype because for me, when I am trying to recruit, I rely on AI to create my job descriptions and my job postings to get the keywords and all of that. And meanwhile, my candidates are relying on AI to create their resume and all the keywords and all that. So essentially, we have AI speaking to AI. So that we bring people in, I don't know what that job is because I'm relying on AI to tell me those keywords. And I'm feeding them BS, they're feeding me BS. We hire them, and they don't know the job. And it's a no-go. So from my perspective, it's a big giant disappointment. And I'm wondering if that has spread to other sectors.
Yeah, I think that's absolutely true, and I think the correlation that we can take a look at is the internet. Because when the internet first came along, and the AI boom is very different in terms of its composition than what we saw with the internet boom, because there was a lot of .com companies that were not profitable or even generating revenues. But the underlying premise is the same: is that when the internet came along, we knew it was going to change the world. But it's been an evolution that's gone on over 3 decades, and it's continuing. And I think the same thing will be true with AI, is that all of this artificial intelligence is just kind of flooded into our corporations and in our personal lives and everything like that. You even hear about it when people are using ChatGPT at home. It's like they first use this thing, and they're like, oh my God, look at all of the answers that I'm getting here. I can have a conversation with it. It's like my friend. But the more they use it, they're just like, oh, okay, well, I kind of see it's like pandering to me. And so there's a long learning curve that we're going to climb. So I would suspect maybe 5-10 years from now, like a lot of those kinks will be worked out, and it will become more productive, and people will be able to use it more effectively. But with that being said, I think about human resources in particular. I think one of the challenges, you heard it with the personal computer, that it was, and yeah, there were people who were like secretaries that were put out of work, but then we had administrative assistants that could do more value-added work. And then with there's one thing that's going to be tough to replace, even if it sounds, when I call into the call center and I think I'm actually talking to a person, I'm really not. Particularly with human resources, there's nothing that takes place of the ability to have somebody on the other side who's receiving your emotion and being able to process that emotion, and where you're not sitting, agent, like when you're calling in the call center, you can't replace that. And I don't know that 25 years or 50 years is going to replace that, no matter how much we have like Rosie the robot and our Jetsons floating house in the sky. People want to talk to people. It's just like, it's like musicians, artists. What's the biggest thing? Why do people like musicians and the music they make? Is because of the personal connection they have and the emotional connection they have. And you can't get that with a robot. So
I personally am looking forward to Rosie the robot.
Get all that laundry done. Yeah.
That's right. I will say what's going to happen is you're going to have specific software that's designed for a specific industry. So you'll have like the HR, AI. I know that personally, that for our industry, there's already AI software that's specifically for the investment industry. Not that it selects stocks for you, but what it does is it goes through it and it gets rid of all the crap, right? So I can I can do research on it and know that it's using like SEC material, company-specific material, real research material, and not like some guy's blog on LinkedIn kind of thing. So and that'll get better, I believe. So I think that'll continue into the future with this very like specific like targeting. There's a big narrative right now, and a lot of companies are struggling, their stock price is struggling because of software companies, and there's a narrative saying that these software companies are going to go out of business because of AI. I personally have a belief that these software companies are only going to get better at what they do using AI and be able to release better products that people will use, because like as a business owner, and Phil and Charlie, you know, I think agree, like I'm not going to sit there and try and design my own programs inside the office. I got way too much other stuff to do. I'd rather pay a software provider to be able to provide me programs that already exist, right? So thinking as a business owner, that's kind of like where I'm at with that. I think that's it. I think everybody's questions have been answered. We've solved all of the world's problems.
Thank you, everybody.
I want to thank Eric. I want to thank you once more for coming out and you know, imparting your wisdom on us. And I wish everybody here a fantastic and fabulous 2026.